Audu, Minister Leminski, as he's leaving, Lord Mayor of Dortmund, Mayor Alexander Kaluti, President of the Dortmund Chamber of Commerce and Industry, Mr. Heinz-Herbert Dustmann, President of Auslandsgesellschaft is also out, members of the diplomatic corps present, and ladies and gentlemen. It is indeed an honor for me to be speaking to this audience, an audience that represents the drivers of the economy of a state, and by this I mean NRV, that if it were an EU country, would rank as either 6th or 7th, an economy that is comparable to that of Poland. Poland is a bit bigger now. An economy that, because of this, has benefited from an integrated global market and supply chain, and that must also now be feeling the effects of the current geopolitical and geoeconomic climate on that global market and supply chain. Over the next 20 or so minutes, I'll try to keep it short, we're going to look at the hard data of global supply chains. We will examine how geopolitics is reshaping these chains, where Africa currently stands in the changing geopolitical landscape, and the practical implications for German businesses, especially the Mittelstand. Here's a hint. Africa should not just be seen as a potential export destination. It should be seen as central to Europe's, Germany's, NRV's risk and growth strategy. So let's start with the baseline of how Africa trades today. Historically, African trade has been dominated by primary commodities. Looking at the composition, the vulnerability to Africa is clear. Here are the data points. In 2022, 79% of Africa's total exports were primary goods. Fuels alone accounted for 42%. Manufactured goods made up just 21%. Right now, 45 out of 54 countries depend on exporting raw materials and natural resources for the majority of their income. Now, just to balance this out, this is not a specifically African condition. The trade data in South America are similar, with the commodities share of exports of 11 out of 12 South American countries making up over 80%. We also have similar figures in Central Asia. However, for Africa, which has the youngest populations in the world, commodities export is particularly problematic because it does not create the jobs that these young populations need. I will be coming back to the initiatives that African governments are pursuing to change the situation, but please keep these data points in mind. So who does Africa trade with? The buyers of African commodities were for a very long time predominantly European. In 1990, for example, about 60% of African commodities was traded with Europe, only 1% with China. But 30 plus years, things look very different. These are the figures today. The EU 27 remains the top trading partner at $187 billion, but China is effectively, tied at $186 billion. And I will keep bringing up China here, not to provoke, but just to illustrate certain points. India is surging at $70 billion, followed by the UAE and the US. Afreximbank's 2024 data shows Asia-driven momentum in Africa. Africa's merchandise exports to Asia rose by 10% in just 1 year. China now commands nearly 16% of Africa's global exports. It is fair to say that the East is where the trade increasingly is for Africa. So I presented the EU figures as a block, but what happens if we break things down a little bit and take Germany out? German-Africa total trade rose 10.5% year-on-year in 2025, reaching 63.4 billion euros. This figure is lower than India's trade with Africa, slightly higher than the United Arab Emirates trade with the continent. Germany's exports to Africa are mainly vehicles, 17%, machinery, 14%, and chemical products, 9%, similar to its general global export mix. But how does Germany actually trade with Africa? What's the pattern here? As you can see, Germany's trade with Africa is slightly concentrated. South Africa remains Germany's largest market by far, with a 32% market share, followed by Egypt and Morocco. North Africa remains Germany's primary sales region on the continent. But the sweet and positive spot in terms of growth over the past few years is West Africa. Regional exports are up 24.6% to 3.6 billion towards the region. Nigeria leads with 1.1 billion, over 21.1% of the total, followed by Cote d'Ivoire and Ghana. There's an argument to be made here that German businesses could go to Africa starting from where they already are and then regionalize from there. But it doesn't have to be so. So let's shift gears and look at FDI, because trade is just half of the picture. As you can see on the slide, FDI into Africa surged 75% to 97 billion in 2024. North Africa led this rebound, largely driven by Egypt, although countries like Morocco also grew by 55% and Tunisia by 21% FDI towards them. Although overall greenfield investment declined, there's an exception in North Africa where greenfield investment rose 12% to $76 billion, capturing about 2/3 of Africa's project capex. When we look at where the money is going, we can see that the energy transition is reshaping flows. We saw 7 major deals in this sector worth 17 billion, with Egypt, Morocco, Namibia, and Tunisia. So let's look at the investor landscape on the continent. Europe still holds the largest FDI stock. Europe, the EU, 27. But given the growth of Chinese FDI, I will be focusing a lot on China today. Remember that I said 1% of trade with Africa in 1990. China's FDI stock is estimated at 44 billion, and it is increasingly diversified into pharmaceuticals, food processing, motorcycle manufacturing, and building materials. About 1/3 of Belt and Road projects now target social infrastructure and renewable energy. So the key investment sectors that we see in Africa are this. Greenfield investments are dominated by energy, by construction, and by extractives. Energy leads greenfield investments, signaling a growing FDI in energy security and energy transition. Construction comes second, and it has fewer projects but higher value. So if you look at it, it kind of looks like it's bigger, but it's actually second in number of transactions. And extractives come third, which is driven by global demand for lithium, for cobalt, rare earths, and so on. The top recipients of the extractives projects are mainly Guinea, DRC, Uganda, Angola, and Libya. So let's summarize what the data is telling us. It's telling us that investment is rising in renewables and critical minerals, no surprise, while FDI in fossil fuel processing is declining. The digital economy is emerging quickly, with project value increasing by 75% over 5 years. Electronics and electrical equipment are seeing increased greenfield activity, suggesting Africa is beginning to capture niches from global value chain reconfiguration. Pharmaceutical FDI shows very little growth despite localization efforts, highlighting persistent barriers to scaling medicine production on the continent. Agricultural investment, and this is the one that pains me a little bit, is collapsing despite its high developmental potential. And last but definitely not least, there's obviously a disconnect between where global capital is going and what African economies are saying they want. So let's try and look at what African countries say they want. So African governments are saying that the previous growth model that I described earlier of commodities exports offers limited opportunities to meet the continent's development agenda. They have created some strategic responses to this, the first one of which is Agenda 2063. They have also created specific visions around specific areas. So there's the African Mining Vision and the African Union Commodity Strategy, both of which prioritize industrialization and processing across commodity value chains. They also recognized that one of the reasons that it is difficult to set up manufacturing in Africa is the size of the individual countries' markets. So they're working towards creating a continent-wide market. Here you see a bit more details on Agenda 2063. It's a general policy direction, and it links growth and industrialization, manufacturing, value addition, and so on. But let's skip this and move on. So that's General Continental Vision 2063, African Mining Vision, Commodity Strategy, and different pronouncements from the continent are being turned into policies on the national level. Nigeria is passing a value addition bill on all raw materials, mandating 30% local processing before export. Ghana has banned raw lithium exports. Zimbabwe has even gone further to ban not just the export of raw lithium, but also of lithium concentrates by 2027. Namibia wants to transition from raw/semi-processed exports to high-value intermediates, and targets in Namibia include copper, zinc, to pure metals, and pilot beneficiation for lithium and graphite, local processing. Côte d'Ivoire targets processing of at least 50% of cocoa beans domestically by 2026, up from 30%. In South Africa, a recent policy requires producers to make available minerals for local beneficiation at a state-determined base price. So, what sectors are African countries prioritizing? Given the resource and commodity base that the countries are starting from and the need for industrialization, the priorities sectors make sense. We are saying manufacturing, including light manufacturing, components, and industrial services as a job strategy. We see agro-processing, we see mineral beneficiation, which is anchored on the African Mining Vision that I mentioned earlier. And because none of this work without infrastructure, Africa's infrastructure requirements are commonly cited at around US dollar 130 to 170 billion annually, with a persistent financing gap. Because infrastructure is very key to all of this, infrastructure and connectivity is also a key priority for African countries. So, what is Africa looking for in strategic partnership? They are looking for investors who will process locally, build backward-forward linkages, source inputs domestically or regionally, investors who will train and certify workers, transfer know-how, build industrial services, those who will deliver transport corridors, energy reforms, energy systems, logistics, and digital backbone using risk-sharing structures, and those who will build renewables and green molecules with local industrial spillovers. So the engine that the continent wants to use for this, like I mentioned earlier, is the African Continental Free Trade Area. It is not just about trade, it is about the right kind of trade. Trade that supports local production, industrial growth, and structural transformation. So why does AFCFTA matter to foreign investors? Well, Africa is a market, AFCFTA is a market scale machine covering 1.3 billion people. But the idea is that it rewards those who localize. Because of rules of origin, preferential tariffs only apply to goods made in Africa. Furthermore, PAPS, the Pan-African Payment and Settlement System, now connects 16 central banks and 150 commercial banks. Thanks to this, trade is increasingly settled in local currencies, and dependence on hard currencies is reducing. And with the Guided Trade Initiative launched in 2022, the AFCFTA has been piloting real commercial trading under AFCFTA rules, showing integration is phased, operational, and practical, rather than instantaneous. So, how has the world responded to Africa's ambitions and preparations? Let's see. So, first of all, before I go into a few of the case studies, this is how we should interpret the responses, okay? So, first of all, Africa is not looking for more investment alone. It is looking for greater value capture through processing, manufacturing, skills, standards, and infrastructure that strengthen regional and global competitiveness. Based on the ambitions that African countries have voiced and that I detailed earlier, we have identified, broadly speaking, 5 action types that signal real intent to respond to Africa's ambitions. 1, downstream industrial investment, which includes things like processing, refining, plants, components, assembly lines. Second is value chain partnerships and roadmap, which can be signified by agreements covering local value addition, technology transfer, skills development. Third, standards, testing, and R&D infrastructure, because you want to access the markets outside, so you need all of the standards. And of course, trade enabling infrastructure such as ports, rail corridors, terminals, and so on. So let's look at a few case studies, starting with China. As already mentioned earlier, China's Africa FDI stock is at 44 billion. Sorry, that was from 2022. 2024 is $44 billion. And it is increasingly diversified into pharmaceuticals and food processing. They are also investing in some downstream manufacturing. They are building battery gigafactories in Morocco, lithium processing plants in Nigeria and Zimbabwe. They are building the standards and testing infrastructure to ensure these products can hit global markets. My estimation is that African countries, if they play their cards right with China, will host some of the places where China manufactures intermediate industrial products for markets in the West when the tariffs hit them, because the tariffs will hit them. So, the proximity is something you simply cannot beat. And they've done this before. The UAE's response, the UAE is deploying equity mega deals like the 35 billion Ras El Hekma project in Egypt and locking down ports and logistics corridors across the continent through DP World. DP World's ports of Ndayane project will turn Senegal into a West African gateway, and the ongoing Banana project in the DRC will bring direct sea access to the country's 100 million people for the very first time. DP World has operations in Angola, Algeria, Egypt, Mozambique, Rwanda, Senegal, and Somaliland. The EU's response is organized around the Global Gateway and the Critical Raw Materials Act, which is actually not about Africa, but it's hard not to read Africa from it, given the preponderance of minerals in the trade with Africa. It mentions value addition on the continent, but I've heard from people that it doesn't contain any financing mechanism. So, the relevant EU package under the Global Gateway is the Africa-Europe Investment Package. It prioritizes energy transition, digital connectivity, transport corridors, health, manufacturing, and skills. So let's look at a few concrete German examples, because Germany is actually pretty present on the continent, not as much as we would all like, but let's look at the content of that and how it fits with Africa's priorities. So in Morocco, we can see some automotive component manufacturing. In Ghana and Rwanda, Volkswagen has an assembly plant. In South Africa, we see Siemens and Aspen Pharmaceuticals engaging in technology transfer and productivity upgrade in local manufacturing. And again, in Rwanda, we have BioNTech investing in local pharmaceutical manufacturing skills, innovation ecosystem. I know that this audience definitely has a lot more examples, so if I didn't mention your company, please excuse me. Now, let's look at the observable gap between policy rhetoric and business action. Apart from the bright spots that I mentioned, for Germany, broadly speaking, there is an MOU to money friction. Memorandums of understanding are signed, but execution is slow. There's limited German risk mitigation tool for African investments, and this is a complaint I've often heard, and the data bears it out. Africa accounted for only 9% of Germany's approved investment guarantees in 2024, versus Asia, 46%, Eastern Europe, 43%. Export credit guarantees for Africa fell 61% in 2024 to 2.07 billion, signaling fewer financed export deals, especially affecting SMEs. If we want Germany to invest more in Africa, we obviously have to do better than this. And I am afraid that we are getting slightly too late to be better at this, especially when we consider the current geopolitical and geoeconomic risks that European companies, and in particular German companies, are facing. Supply chains are now geoeconomical. I am sure that I don't have to spell that out for this audience, that there are risks coming from the East and increasingly from the West. Why does this matter here? Well, Europe imports more than 90% of rare earth magnets from one actor, which highlights direct exposure in automotive, defense, aerospace, AI chips, data center, and so on. We know what happened when the ban was announced last year. Moreover, the EU's demand for rare earths is projected to grow 7 times by 2050. German industry groups have repeatedly framed export controls coming from China as an urgent signal for Europe to reduce dependency, notably after the initial gallium germanium controls. This was not the last year one, but that was already a couple of years ago. At the same time, Germany's export model is under pressure. German car exports to China has been on a steady decline, dropping 15% alone between 2024 and 2025. We are seeing similar drops in machinery and chemicals. This erosion in a core market directly reduces scale advantages, learning effects, and competitiveness at home. Given Africa's current development trajectory and demographic structure, Africa is definitely where the future market share will be, and competition is intensifying. The minister said that already earlier. Afreximbank shows a rebalancing of Africa's trade geography in 2024. Asia's share of Africa's exports rose to 25.6%. The European Union share fell to 24.9%. Asia's share of Africa's imports reached 28.5%. The EU's fell to 24.85%. Now, this is despite the fact that EU-Africa goods trade still total $355 billion in 2024. The issue is relative position among multiple players, not absolute volume. So given all of the above, the current decline in manufacturing in the West, and the pressures in third markets, is there a way for German companies and public sector to take the ambition that African countries have expressed seriously and make that part of how they cope with the current Asian and American headwinds? My proposal is that Europe, Germany, NRV have to look at where the market of the future is, where there is still growth to be had, where some of the resources are, and a place that is so close to Germany that it's just 1 or 2 time zones away. These are some of the reasons that it just makes sense to look at Africa. Africa fits Germany's need for supply chain diversification perfectly. Just as the minister said earlier, it's just too concentrated. It's just not smart. Because as supply chains are reconfigured for resilience, new production nodes become attractive where they reduce concentration risk, meet cost, energy, logistics constraints, and align with local value addition policy. So let's take a few examples. Nigeria's move towards Chinese-backed lithium processing plants is explicitly framed as moving away from exporting raw commodities and adding value locally. The same with Zimbabwe, where 2 Chinese companies have invested in refining lithium concentrates, and where they are now investing into further processing of lithium concentrates into lithium sulfates and intermediate products, which can be refined into a battery-grade material such as lithium hydroxide or lithium carbonate. The country frames this as a success story of pushing for more local value addition. Or take Turkey's Toshali, which has built an integrated steel complex in Algeria. Algeria also frames this as an integrated industrial zone that aligns with local value addition policies. And the gaps in Africa's markets are exactly where Germany is strongest: machinery, plant, engineering. This also aligns with existing EU-Africa trade patterns, where machinery and chemicals are major EU export categories, but now make it in Africa. It just makes sense for Germany to make production in Africa part of its diversification strategy. And here are some additional strategic gaps that Germany could fill. We often focus on the glitzy sectors of machinery and engineering, but there are some very key sectors without which we cannot survive as humans in 2026, and where Africa requires investment. 1, food and agro-processing, where investment has collapsed, and projects down 50% despite food security being critical. This creates space for German machinery storage, German processing, irrigation, digital agri-tech to come in. In health and pharmaceuticals, FDI remains weak despite localization policies, which is also a clear opening for German process engineering, quality assurance systems, cold chain, etc., etc. So, where do things stand at the moment? Germany's strategy, I feel, should be emphasizing de-risking and diversification yesterday. But if we look at where things stand today, looking at business data, there is very slow structural adjustment. 2022 preliminary data with China, trade with China shows that with China of 81.3 billion exports versus 170.6 billion imports shows increasing dependency. So we are importing more, exporting less to China. As I mentioned earlier, Germany's investment guarantees activity of 2024 show that projects accepted in Africa are in a minority, 9%, while Asia accounts for the largest portfolio share, 46%, and China remains the top portfolio market by value. Here's what this implies. There is strategic intent, I think, but execution bandwidth is limited. What this does is that it creates space for agile, mid-sized firms to move earlier than large incumbents. So, key takeaway: Africa's industrial and market ambitions are increasingly relevant to Europe's competitiveness because supply chains are now geopolitical. Export restrictions, especially on critical raw materials, are rising and evolving. Licenses are becoming a decisive bottleneck. Europe and Germany remain highly exposed to concentrated supply chain. Competitive pressures in third markets is already visible. German auto exports to China fell, and so on and so forth. Africa is another arena where market share is actively contested, and we're already seeing that changing with Asia compared to Europe. For NRV SMEs, the winning posture is partnering for value addition, investing selectively, and treating Africa as part of a resilient supply and growth strategy, not just an export destination. And last but not least, Germany and Europe should not do it for Africa, but for Europe. Europe's economic resilience, strategic autonomy, and dare I say, political stability depends on it. Thank you.